Okay. WebEx is not letting me record. Let me try again. Okay, there we go. Recording is in progress. Great. All right. Let me see if I can let Dorian in. Okay. Uh-oh. Allison, nope. I think you're good. Okay. All right. Hopefully, if as people come in, I'll be able to let them in as they wait in the lobby. So I'll try to keep an eye for the lobby and make sure everybody that wants to come in can get in. All right. So yeah, we got a really good turnout today. So again, welcome. We just like to talk about what's going on in the market because what happens in the news, what happens economically can affect how economic measurements that have been coming out. And just this morning, if you haven't been please switch switch networks if I need to. Come on, WebEx. All right, hold on. It was working fine before. All right. Let me, oh, we're back? Thanks, James. Okay, good, good. Knock on wood that you guys don't lose me again. All right. Always, since I just moved into the apartment today, this is the first real test of streaming. So, uh, it worked last month when I was in Thailand. So I was hoping it would work just as well. So, all right, everybody keep their fingers crossed you don't lose me again. So anyway, geopolitics, again, what's going on in Iran has been affecting oil prices as well as the economy. But a a couple of the major catalysts just came out within about an hour and a half ago, and that's inflation measures. So GDP, or gross domestic product, went up an unexpectedly low 1.4%. So that means the economy could be slowing down based on this metric, and that's usually a negative catalyst for stocks. And then simultaneously, since we have the government shutdown in the fall, another metric, which is the personal consumption expenditures index, basically how much consumers are spending, that came in at 3%. So that tells us, and it is the preferred metric of the Federal Reserve to gauge inflation, how much prices have gone up for personal consumption. And this is excluding two of the most volatile sectors or parts of consuming, which are fuel and food. Take that out, that means prices have been going up at about a 3% pace. Now, as the Federal Reserve sees it, in trying to determine whether to raise or lower interest rates, that's kind of high because the two main mandates of the Federal Reserve are to have stable inflation and to have stable prices. And prices right now are still a little high. The goal for the Federal Reserve is to have about 2% inflation, and 3% is still too high. So markets don't like that, and here's why. So stock markets will generally move low. If they think that prices are still high, that means the Federal Reserve is less likely to raise or to lower interest rates like they did in the fall of last year, because higher interest rates are what keeps inflation at bay. So then you have two competing metrics here. If the economy looks like it's weakening, which is what this low GDP number, they were expecting a GDP of like a whole percentage point higher to 3%. But now it came in at 1.4. So if the economy is slowing down, then that usually signals that maybe to help boost the economy, we should lower interest rates. But then we may not want to do that because prices are going up. And this is a combination of tariffs and other factors affecting prices going up. A good bulk of it's probably tariffs. So this is what's giving the Federal Reserve pause, and maybe, and that's why they voted a week ago, last Wednesday, not to lower interest rates this go round. So interest rates are still going to stay high because inflation is still a concern, but the big money is on that interest rates will probably be lowered maybe 1 or 2 times this year because of this number, a weakening economy. And then another measure is going to come out next month about how hiring has been. So less jobs available, more of an impetus for the Fed to lower interest rates. But the job market's actually been, despite what we usually feel, because it feels like pretty much everyone I know who's looking for a job or just graduated and are looking for a job are not finding jobs. So the job market is pretty challenging right now. So seems to be odds on money that interest rates will be lowered, but probably not to the extent that the president wants. So this was the big news just within the last probably 20 minutes. Supreme Court strikes down the International Emergency Economic Pricing Act. So the tariffs that were enacted by the president using this act as justification, the Supreme Court just decided this morning that they're unconstitutional. And so that was a big swing in the markets, and it looks like this. We should be hitting green on the market right now because they were in red all morning. So as soon as the Supreme Court knocked down tariffs, we could see a jump in the market. These were all red. The Dow Jones, the S&P 500, and the NASDAQ, which are, technically your tech stocks. So yeah, Anna saw that too. Big swing from red to green as soon as the Supreme Court news came out that they deemed those tariffs unconstitutional. That is considered a positive for the market. And those of us that are students of behavioral finance like that, because if there are less tariffs, that means businesses will pass down less of those costs, price increases, other inflationary factors down to you and me, the consumer. And so hopefully that'll spur more spending, more business, and the market just sees that as a positive. Now, market's going to be open for another 3 hours and 58 minutes, and we'll see how long this green lasts, because under this environment, it's been pretty fickle. But my money's hopefully betting that hopefully we'll close on the green for the day. So we're at the halfway point, and so we are hopeful for that. So again, it's always good to look at news as a finance guy, a specific way, and how does this affect my money? And so looking at factors like this, getting past all the fluff news and politics, get down to what matters with your money. Now, we have an interesting topic that one of our members suggested, I think a couple of months ago, and this was one that we haven't talked about in Moneymakers, is how to invest in private equity. So one of the things that has been in recent news over the past year was that for the first time, President Trump signed an executive order allowing regular folks like you and me to invest in private equity inside their 401ks. But let's start right at the beginning and talk about, and by the way, if you are on the email list, then you get all the handouts. So I'll make sure to email this handout to everyone. So what is private equity? So private equity basically gives people with some cash, historically, an opportunity to invest in companies that are not publicly traded. Generally, if you want to buy a piece of the company, you just buy shares of stock. You know, go on your Robinhood app, and maybe buy a few shares on that. But this was or private equity has generally been in the realm of wealthy individuals, high net worth individuals, because the SEC, which regulates a lot of our financial rules and financial institutions, to protect consumers, basically says, well, if you don't have the assets, that means you may not have the savvy to determine if private equity investments are good for you, based on a certain level of risk. Well, with the executive order the president signed last year, this kind of opens it up to regular households like you and me. Oh, you're right on time. We talked about the economic stuff, but you'll be able to catch the recording. I'll post the recording, and you'll be able to watch it later. So if you missed the first part, so no worries. I'm glad you're here. So private equity means investing in companies that are not publicly traded. Generally, these could be startups. These could be companies that are high growth. Could be companies that maybe need some capital boost, some funding boost to help expand their businesses, or maybe pivot to a new product or service. So this is the particular executive order, and I put a link in the handout for you guys. So it was signed just last fall, in August of last year. This allows 401ks in any of your regular retirement accounts to invest in private equity as an additional asset class to choose from. So the actual executive order is called Democratizing Access to Alternative Assets for 401k Investors. So this is right directly off the White House's website. So what is it something we want to be concerned with? Well, this type of asset class has been in the realm of just, again, the ultra wealthy. So they can invest in early stage companies right as they take off, before they even become public. So, I mean, such a huge advantage, especially for a lot of familiar names in artificial intelligence or fintech that are private, that we wouldn't be able to have a chance to put our money into to grow our assets. So there's a potential for long-term high returns. You get access to investing in companies that are at the cutting edge of different industries. And you get to diversify your portfolio beyond your mutual funds, your stocks, your bonds, your crypto. So before the rule was enacted, again, you had to have a lot of money. Basically, the term that financial institutions used to screen you before they allowed you access to these types of investments is that you had to be an accredited investor. So an accredited investor in SEC terms means you have to have at least $1 million net worth, or you have to have annual income of $200,000 a year as an individual. So that would qualify you as an accredited investor. The logic behind that is, well, if you've made that much money, or if you make that much money, you should have at least some, I guess, background, education, skill set to discern taking on a higher risk, high reward type of asset class like a private equity. So there are pros and cons for private equity. One of the biggest ones, which goes against one of my trading rules for assets, is private equity is illiquid. You can't just buy and sell them like you do stock every day on an app. You can't necessarily time the selling of shares in private equity when you want to. There isn't as big of a market for shares in private equity like there is for stocks and ETFs. As a matter of fact, there's something called a lockup period. You may be forced, if you invest and put in for this high return, in exchange, you got to be patient. You may not be allowed, sometimes depending on how the private equity investment's written up, you might be forced to hold on to this for 5 to 10 years to give it a chance to grow and earn a return for you. So there is that risk that your funds are going to be locked up for a while. So what about an average retail investors like you and me? So what this executive order opens up is the creation of ETFs or investing in the stocks of private equity firms, which we can do already. So low-cost ETFs, and I mentioned Robinhood's new one. Actually, I'm putting just a small amount into it because they have a few high-growth known firms that are within their portfolio that's just coming out this month. There's other ones that I list, and again, do your due diligence to look at the performance. We'll talk about that later. There's Putnam Business Development Income ETF. There's another one called Power Shares Listed Private Equity. So you can use Power Shares as an intermediary to invest in private equity at smaller amounts. ProShares Global Listed Private Equity, Invesco, which is a fairly well-known brand. ER Shares Private Public Crossover ETF. So, and there's a few more, but these are some of the major names that have developed products for small investors to get in on private equity. Now, if you don't want to invest directly into shares of private companies, then alternatively, you can invest in companies that create the private equity products that you can invest in. For example, KKR, one of the biggest financial institutions, Blackstone Group, is publicly traded, and I've traded shares of that. Apollo Management, TPG, the Carlyle Group, Ares Capital, Ares Management, Oaktree Capital Enterprises. All of these have shares of stock that you can buy. So if you like what kinds of private equity ideas that these firms like Blackstone and Oaktree and Ares are managing, then you can buy shares of those. And you can take advantage of the share price growth in those ETFs if all of these private companies take off. This also saves you on commissions too. So versus traditional investment, direct investment into private equity, buying the ETFs usually has a lower minimum amount. So you can actually look up the ticker symbols. Oh, okay. No problem, Jennifer. Glad you can make it. And this is recorded as well, so you'll be able to watch anything you missed. So publicly traded firms, you can buy shares of these. You can buy one share, you can buy several shares, and a lot of these shares are within easy price range for most retail investors. Probably one of the biggest benefits, instead of direct investment into private equity, is this factor here, liquidity. You can easily buy and sell shares. There's a liquid market for these every day on the stock market, and you can use any financial apps to buy and sell these daily. So one of the reasons why I always, and I learned from one of the best traders out there, Tom Sosnoff, one of the reasons why liquidity is widely considered one of the number one rules for when you're looking at shares of stocks and ETFs is that the more liquid shares are, meaning there's shares are bought and sold in high volumes every single day, that means you're likely to get more of a fair price as a buyer or a fair price as a seller. and you get better execution of those trades if shares are highly liquid. That's why when I tell students, and of course all you club members out here, that if shares are not that liquid, and if there's a wide gap between what someone's willing to buy shares for versus what people are willing to sell shares for, then that's illiquidity. So you don't want to see a wide spread between the buying price and the selling price, because that way you know if you're going to get a fair price or not. And you find a lot of illiquidity with sparsely traded shares, like in these private equity markets. Also, you find that a lot with penny stocks too. So I said, if it's worth less than $8, sure, you can get a whole bunch of shares for it, but then it doesn't pass the Swan test, meaning that the sleep well at night test, knowing that you don't want to wake up the next day losing a lot of your money on the stock that wasn't worth that much to begin with. I'd rather buy a $150 share of one stock that's probably not going to go out of business anytime soon than 100 shares of penny stock that's not that liquid. All right. So another pro of going the ETF or buying shares of the publicly traded private equity firms is that you can diversify amongst different firms or different strategies. So there's ETFs that could be different strategies. Maybe you can invest in the ETF that deals specifically with chips, or there is one on, let's see. Oh, in what market conditions does private equity typically outperform public markets? That is a great question. I think right now, this is a stock picker's market because there's such unpredictability, high volatility right now, because we have an unpredictable market. We have an unpredictable executive branch administration, and that affects markets. So doing your due diligence and picking and choosing specific stocks can outperform like broad markets like the S&P 500, which a lot of that is more possible now because the S&P is pretty flat or down since the beginning of the year because of this uncertainty surrounding markets. Private equity, because they are managed by professional managers, basically humans putting the human touch on it, versus an index fund which automatically is programmed to buy the 500 biggest ones like in the S&P 500. Theoretically, individual picking or individual investing in private equity can potentially outperform the public markets, but a lot of data shows that it's more often than not that the markets will likely beat the pickers. So over a long period of time, it's very hard, and the probability is generally lower that private equity can outperform public markets over a period of years. They can beat public markets in any given year. This is probably as good a year as any for individual pickers like you and me to outperform the market, because we're more nimble than someone that has to move a larger ship. So that's a great question. But an environment like this one, volatility versus say gradual growth, little volatility, that's the bull market you want, and that's when it is more challenging to outperform the public markets. So this is part of the executive order, the new democratization of private equity. You don't have to be an accredited investor anymore to participate. So, like with any other asset class, there's risks. One of the biggest ones I mentioned, illiquidity. Since there are not that many shares bought and sold of these private equity shares, then there's not that much of a market for it. You may be stuck with those shares for a long period of time as a private equity investor. And yes, you can shelter it in your 401k, but is it really the best investment for your retirement strategy? I don't know. Private equity can be volatile too, because these are high growth, sometimes on the cutting edge types of companies, and some of the technology may explode, some of them may fail, and so you're kind of sunk. There's also usually higher commissions with private equity as well. Are you willing to absorb that higher fees for the higher return that you were expecting with these? Some are closed-end funds, so you might be buying shares more than what they're actually worth on paper. So you're paying a premium for them. Some of them may be worth less than what they're worth on paper. So great, you can get at a discount for your shares, but there might be a reason why those shares are at a discount too. So we can apply the same rules for when we're shopping for a stock, like we've talked about in earlier meetings. Do your due diligence when you're shopping around for private equity. Look at the prospectus on how the private equity fund is trying to shoot for. I think one of the newer ones that I took a look at today focused a lot on space technology, and they're looking at the absorption of, I think, SpaceX and one of the other artificial intelligence companies. So that's on there are funds, private equity funds out there that are looking to put their money into space technology. Look at the fee structure. Also, just like when you're doing your homework on stocks, look at the historical performance. If you can get information in the prospectus about their performance, how have those fund managers managing the private equity performed investing in all these startups? Another alternative that I looked up for you guys is there are private crowdfunding sites. These are different than GoFundMe. So these particular sites are actually allowing you to invest on a small scale into startups that are needing capital to either start, grow, or expand their business. So Seed Invest is one, Local Stake, and one that I've heard of a lot, Start Engine. So the firms that sign up to be part of these crowd-funded private equity websites, they can raise capital, and they can do it in small batches from a whole bunch of investors from the same website, just like GoFundMe or Kickstarter, for example. Well, what you get in exchange, unlike GoFundMe and Kickstarter, for example, is you aren't getting like free samples, or you aren't getting like first access to a new product launch or game. What you're doing with these crowdfunding sites for private equity is that you're getting a piece of the company, maybe shares, maybe you're an IOU that they owe you a return of your funds back, maybe plus interest, or you get shares of the revenue generated from your contribution to the private firm. All right. So again, this is the Private Equity 101 handout that I made for you guys today. Before we talk about anything else, does anybody have any questions on private equity? We had a couple of good questions on this. Feel free to put in the chat box. When looking at performance, what would be something to be more cautious of staying away from? Great question. So when I'm looking at performance, I like to see trends, and I like to see longitudinal trends. So I'm looking if they have the data, maybe 1 year, well, if I'm trading, usually I do like 3 months, but for like fund shares like this, I'm looking at the typical 1 year, 5 year, 10-year performance. And I want to see, and since it is private equity, I expect to see double-digit growth over those years. And it may be challenging because these guys are paid to outperform the market. And if I can get around the same performance on the market with a lot less fees, then I would be challenged in finding a private equity that can generate those types of returns. I mean, we're talking about the expectations would be 20% returns or more. I mean, in exchange for that, how much are you willing to tie up your own personal capital for those returns? Can they demonstrate those 20% returns roughly year after year? I think it's pretty challenging, especially since markets can pivot on a dime and go from just a chaotic market like we've had over the past few months or since April of the year before to a conventional bull market where you can just set it, forget it, not have to babysit in an S&P 500. So yeah, I take a look at 1 5-year, 10-year performance if they have the data. Like if you're taking a look at like Blackstone, Apollo, Carlyle, look at their prospectus and see how their managers have picked and chosen the private firms that they're putting their money into. If they're launching and going public, then that's great. Look to see if they've got a list of past successes for the firms that they took from private to public, or those private firms that have insane evaluations. You say, okay, this goes to this. You have stocks with you would lose money with this. If the firm, see, I can use Winn-Dixie as an example just because remember off the top of my head. If a public firm like Winn-Dixie goes bankrupt, then if you have shares in your account that basically become worthless, then a couple things you could try to sell them at a loss and then book the loss, and then you could just use that as loss harvesting. Or I've had this in one of my accounts before, where a company has pretty much dropped to penny stock status. And what I did, there's an actual provision in the tax code. Again, I'm not a tax professional. I'm only telling you my own experience. But if a stock does go worthless, yes, you do lose money because it's probably going to be worth a lot less than what you paid for it. So once that's become worthless, you can actually treat it as a worthless stock on your tax forms, like a asset that has become worthless, and you can use that as a write-off for your gain. So if you got stocks that actually you sold for profit, then you can use those to offset your gains. Basically, that's what I did. I just used it to cut back on the taxes I had to pay from any positive return stocks that I sold. But yeah, they become worthless on paper. You just got to make sure you have the documentation to show to the IRS in case they come back and ask, okay, here's what I paid for it. Now it's worth this, and here's why they went out of business or something. Just just have that documentation. So that's a great question, Joy. Hopefully that happens to none of you, where a stock that you bought becomes worthless. But if it does, which can happen, that happens a lot with a lot of penny stocks, especially fallen angel stocks that get relegated to the pink sheets or the off market. Yeah, it's scary, especially if you invested quite a bit. So, and if I sound like I'm scaring you, yes, I am. I am intentionally scaring you because I want you to buy something that's going to be in business for a while. Oh, no, I'm glad you made it. Glad you made it. Is it possible to buy it out and build it? There is, but it's likely, especially if the company has gone through, like, say, even the Chapter 13, but more likely Chapter 7 bankruptcy, it's not likely. In my experience, what happens is and this can happen because I saw it happen with Winn-Dixie stock. Their shares would be considered worthless, and then whatever businesses that tries to buy them out usually will take them private, and then they will come out with new shares differently than the ones that were worthless. Hey, Jesse, that's all right. Glad you made it. This is all recorded, so you can watch it later. So to Joyce's question, yeah, they could buy it out, but from my experience, what I've seen is that companies that whose stock became worthless and then were rescued by a firm, basically buying up their assets, may take the company and have it go public again, but with just new shares, or just absorb the company by buying all of the distressed shares. So, but yeah, that's a great question. Again, I hope that happens to none of you. And all of the stocks that you buy just keep growing and growing and growing, or along the way, pay you a dividend while you wait. So those are actually shares I buy of more are dividend payers, but I still buy, at least for now, once a month. I'm leaning into Meta and Netflix, at least for the time being, especially since Meta's price has, or not Meta, but well, Meta too, but Netflix stock price has dropped considerably over the past year. I'm scooping up some shares while they're still less than $100 each before they turn around again. Because again, they're still the biggest player. And they also can raise prices on you, and people will still sign up for Netflix. Of course, now they're making money with the new advertising portion. All right. Next item of business. Go back to the agenda. Go back to the agenda here. There we go. Feel free to type in the comments section, or just raise your hand. I'll turn your microphone on. Are there any topics you guys want to see and chat about in future meetings in coming months? There's a lot of, and even if we've talked about it before, I certainly don't mind bringing it up again, because there are certain topics that are very popular that come up almost every month, like options. Options has been a popular one, or what to look for in buying a stock has always been a popular one. Any topics that you guys are interested in, or maybe one that we haven't heard about before? Day trading, great one. I have my little notebook here. I'm going to write that down as someone who trades every day myself. I actually put in a couple trades today before the meeting. Let's see, let me write. So day trading. It can be, it is not for the faint of heart, and I always recommend educating yourself thoroughly before considering it. I actually trade, but I actually do it with options instead of stock. Stock does require a little more technical analysis versus fundamental analysis. Oh, what to look for when buying stocks? All right, I'm gonna write that down as another popular one. So what to look for when buying stock, day trading. Yeah, those are good ones. Probably, those are actually good ones for next month. I'm going to put an asterisk beside that. What are options? Oh, okay. I can actually give you the five-minute definition. So options, think of it as like insurance contracts. So what an option does is it prevents you from, it could prevent you from overpaying for a stock. It's like insurance against that. Or it is also insurance from losing money when a stock that you bought price drops. So think of it as an insurance contract. So options are two different types, basically to protect the stock that you bought, or at least hedge or limit the amount of losses you could have from buying stock, or it could allow you to buy stock at a cheaper price than what they're actually selling for. So, and like insurance contracts, you actually pay a premium for those insurance contracts, just like you pay a premium for your car insurance. So again, that I always consider or use the insurance analogy for options contracts. So when I trade options every day on the market, uh, I always consider selling the options, meaning that I want to be State Farm. So the question I always ask students, like, would you rather be the person buying the insurance contract car on your car, or would you rather be State Farm collecting all the premiums from everybody and choosing when to pay it out when someone has an accident? Uh, I think most students would choose State Farm. So my strategy, which I learned from a lot of uh, great traders, is that I prefer to sell the insurance contract and collect the insurance premium, and then choose when to pay the premium back out. So to give you an example of pretty much my strategy is that I will sell a options contract to buy, let's say, shares of Amazon for, say, $200 a share, and someone will pay me a premium for that right to buy Amazon's shares for $200 a share. But right, so let's just say Amazon's selling for $250 a share, and it stays there, or say goes down to $200.01. Well, they're not going to exercise that contract because they can just go ahead and buy uh, shares of Amazon for more than that. So, and also options contracts have an expiration date. So every day that, including nights and weekends, that option doesn't get exercised, then I get to keep more and more of that insurance premium. Can we learn about tax planning, good things we can do now as students? Tax planning is a little tough just because tax is not my forte. However, I could probably round up, actually, I'm going to make a note of that one too. I could probably round up like some common tax strategies that all students should probably familiarize themselves with. Tax strategies. All right, yeah, I'm gonna write that one down too. So, especially as students, that's really good. Pros, cons on spreading money, 401ks, IRAs, TSPs, direct stocks, having one for source of money growth. That actually is a nice one. So, a side-by-side comparison of the different vehicles for investing. So, let me see. 401ks versus IRA versus TSP. Those are really common. Versus buying stocks outright. One thing I can tell you is that you actually, there's an advantage of having multiple accounts, both taxable and non-taxable, because you can have a sequence of withdrawals later in life and control, your taxes that way. Oh, that's a good question. When the company pays dividends, do we also get money from that? Yes. It's one of my happiest days every week is when I get money from sleeping or playing video games. Yes. So just simply the fact that you own the shares, you get dividends from it. As long as you've bought the shares before they declare the dividend and record who owns it, then you're good. So you do have to pay taxes on that, but here's the key. The longer you own the shares, the less taxes you can pay on the stock. So if you've owned the shares for at least a year or more, then your taxes may be only 15% or less. If you're under a certain income bracket, you might not even have to pay taxes on the dividends at all. So this is why I buy shares of dividend paying assets literally every week, sometimes more than once a week, because what I do is I have a little calendar in my notebook, like my shares that'll pay me in the first week of the month, I'll use that cash to buy shares of companies that'll pay me in the second week of the month. And then when I get paid in the second week of the month, I'll use shares of those stocks to buy shares that'll pay me in the third week of the month. So you can actually have a rolling snowball. And I never keep the cash. I always reinvest all of it right back. So yeah, dividend question, great question. Can we learn about tax advantage accounts? Yeah, those will actually fall into the 401k versus the IRA versus the TSP. So I could probably set that up. Would be more info on options if we do decide to use it. Yes. There's a little options primer. Shameless plug, I also teach the investments class, so we go over a whole chapter on that as well. I even made up a little handout just for that section of the class, just because I do, I do it all the time. But for moneymakers, I've talked about options all the time, and I'm always happy to revisit that topic. I think how to buy or what to look for in buying stocks and the options topics are two of the most popular ones that we have in the club. So yeah, that's always good. And again, it's always great that students get to choose what we want to talk about. Is there information we could use to help us with student loan debt management? That is a good question. That's something more, I think probably the folks at Financial Aid probably might be able to help with. Because that's more on the personal finance side, unfortunately, versus the investing side. But yeah, that's a good one. I'm not, unfortunately, the expertise on that one. What's the course ID for investments class? I will tell you. And I'll type it in the chat box too, so that way you guys can see it. It's FIN 4501. Feel free to sign up anytime. I think myself and maybe someone else teaches that class, but I think mostly it's me. And I also teach that live from time to time, which I love. One of the fun things we do in that class is especially if those of you in that class are in the meeting today, I have you do a $1 million portfolio simulation, and I group you into teams competing against each other for bonus points, and it's a lot of fun. And I have different little twists that I require to make in your portfolio to give you exposure to different strategies in the semester. So that's a lot of fun. The live classes have generally been at Kent campus. I know I'm teaching a class at Kent campus this summer face-to-face in the real classroom. I don't remember off the top of my head if it's FIN 3400 or FIN 4501. But, oh yeah, you're in my online class. Great. Awesome. And then I do online live classes too. So, oh, cool. Thanks for the positive comments, Queenly. Well, great. Yeah, I always have members that have taken my class or are taking my class that show up in the club. So it's always a lot of fun. I think this is the best turnout we've had in 2026. It's the second turnout we've had in 2026, but we beat the 17 that came out last month, which is great. So any other topics you guys want to suggest before we head out? I always want to respect your time. All right. Oh, that is good to hear, Jennifer. I'm so glad. I love it when all of the teammates in a group project gel with little or no friction. Awesome, Gina. And I'm always happy to give extra credit too. So, but I figured it's good information anyway. So whether you're here for the extra credit or not, it's great stuff. And since I actually teach this stuff and I'm a practicing trader, it's legit information. Thanks, Bridget. All right. Thanks, Elizabeth. I will add you to the mailing list. Yeah, if anyone else wants to share a preferred email address to get on the email list for upcoming meetings, then please share your email list in the chat box, and I'll be able to see it when I rewatch the video. Can you do more of these before semester's up? Before spring semester's up, I will. Yeah. So I'll be doing another one in March for sure. Great, getting these great emails. Awesome. Oh, Gina, if you texted me, yeah, text that to me. So that way we'll get that. I think you texted me. And I think and I'm sure I replied back that Maggie's also my favorite. Great, great. All right, that's great. Okay, well, I'll keep recording till for the next few minutes, as in case anyone wants to submit their email to be on the contact list for next month's club meeting. And again, feel free to bring your friends. The only requirement for Moneymakers Club is that you're a student or alumni, and there are no member dues, so it's totally free. Have a fantastic weekend, everybody. Have, get some good rest and enjoy. Thanks, Steve. See you guys in class or next month. Thank you. Thank you. Have a great weekend too. Yes, see you in class tonight. Those of you that are in my Friday night class, I will see you tonight. Awesome, Joy. Thank you. Thanks for the email. I'll add you to the list. Oh, thanks, James. I'm looking forward to the rest of the month. Thanks, Malik. Thanks for coming. Glad you made it. Little hiccup, but it worked out. Okay, I guess I can stop recording.